recording this video Sunday evening, 16th of June 2013. It's actually Monday morning here, Sydney time. I hope you had a good weekend. Happy Father's Day to all the fathers out there. And want to do a video about international capital flows and talk about US bonds and the US dollar, because I was quite merrily going along thinking the US dollar was in a nice rally phase and we were breaking above resistance here on the weekly chart. This is dollar index at DX. Blue professional bars here jumping the creek above 84, and I thought we were just going to run away to the upside. We'd spent so much time kind of basing down here in the 70s, 75, kind of down here at the lows over the last couple of years, and then we had these blue professional bars kind of come in last time we hit 80, and that seemed to me the jumping off point from here. But when you look at this chart, we've kind of had exhaustion buying on a kind of a left shoulder, bearish divergence, first bearish divergence pattern come in, and then the rally back up into that 84 level was a flush pattern, flushing out the last of the buyers. And then since then those blue professional bars got broken to the low, and we've had, you know, some pretty serious weakness in the last couple of weeks. So that kind of got me confused, because I was all kind of ready thinking, you know, dollar index bull market, you know, what's the problem? And then similar type thing with the bond market. So this is 30-year Treasuries, US at US for the continuous contract here. And although, I mean, this thing has been in a monster bull market for 30 years, we all know that. And my expectation was that, yeah, it wasn't going to, you know, go screaming to new highs, but it would certainly be supported because the Fed wanted kind of low rates. And even though we'd put in pullback to end of trend sequence with an exhaustion buying pattern here, first bearish divergence and a flush pattern all the way back up, that this kind of support that we'd found at the bottom of the channel here with blue professional bars kind of coming in would show, you know, the size of this channel that the Fed were willing to tolerate, and that they'd kind of let rates kind of continue down or be weak, and so the bond market would be supported, if you like. But as you can see, the last 3 or 4 weeks, you know, the bond market's kind of sold off pretty hard, and the question in my mind is, you know, again, is this kind of like an end of trend pattern? Is this, you know, the end of the bond market, bull market in bonds with pullback to end of trend, waiting for second cyclical turn after exhaustion here, flush pattern and so on? Are we rolling over into a bear market in bonds? So I've not kind of put up many charts on the US dollar index and the US bonds, because I haven't understood kind of what's going on. I'm not professing to understand what's particularly going on now, but I've kind of changed a little bit of my tune. I've got a little bit more understanding of the international capital flows. So I thought it'd be handy just to run through how I see things kind of playing out and what's going on at the moment. So let's have a look at international capital flows. For me, the easiest way to look at this is in terms of asset classes and countries. So the major country zones that we need to be looking at is Japan, the US and Europe. Yeah, we've got China, we've got Hong Kong, we've got kind of the Asian markets, but a lot of those, Brazil, Australia and so on, I kind of classify as emerging markets. So you could add them as an extra grouping here to understand kind of the full flow, but just to kind of keep things simple, just kept it to Japan, US and Europe. And then the major asset classes, equities and government bonds. We've obviously got corporate bonds, and we've also got things like commodities as well. But again, just to kind of keep things kind of simplified, I've just put it into kind of equities and government bonds, and it's kind of the private sector and the public sector here. And then the currencies are effectively a measure of those cross-border flows. You can have flows between assets and then between countries, and just understanding what's going on. For me, that chart kind of is a helpful kind of simplification of what's going on. So using that, what have we seen in the last 6 months up till April? So that's the last FOMC meeting that we had in April. So October 2012 to April 2013, which is about a 6-month period. What actually happened in the markets? Well, we've had this really strong rally in equities. It's been extremely strong in Japan. I think they were up something like 80% low to high on the last move up. We've had a continuation of the bull market in the US, and Europe's kind of followed along. We've had a mixed picture in terms of bonds. The US bond market, I was kind of assuming was still in an uptrend, but when you look at the figures, between this period, really bonds in the US kind of did nothing. They kind of were in a bit of a range, bit of a consolidation zone, and kind of did nothing. In Europe, we've had a little bit of a rally in bonds, particularly the periphery bonds. So the rates for the periphery countries in the US in Europe have come down, so the bond markets have gone up. We've had a continuation of kind of flight to safety into German bonds. And then in terms of Japan, well, there's been an exodus from Japanese JGBs, Japanese government bonds, and so the rates kind of spiked in Japan and caused a little bit of panic. And then in terms of flows, I was quite happy with the US dollar kind of trending up. We had Japan again in massive decline in terms of their currency. I think they were down almost 30%, kind of high to low in terms of the currency going on there. Europe, a little bit of a mixed picture. The pound definitely has been weak and down over that time period, but the euro again has kind of been caught in a little bit of a range. So that's what's been going on. How can we explain what's happened? Now, my initial assumption, and this was probably a little bit naive, was that we had a couple of things going on. We had a capital flight happening with a little bit of a European banking crisis, and I viewed the capital flight because the US dollar was going up and we had the pound in particular coming down and the Japanese yen going down. The money was flowing out of Japan into the US, out of the UK and into the US. The UK economic story has been pretty weak, and so again the strongest economic story has been the US recovering faster than the other markets, and a little bit of a breather from the emerging markets, a bit of a rotation out of emerging markets back into the US market. So that would explain in my mind a capital flight from Japan and the UK into US assets, and that was initially flowing into kind of short-term treasuries and then being reinvested in equities, and so kind of flowing through government bonds into equities, and a little bit of what was called at the time rotation. Whether that's been a mirage or not, is yet to be seen, but the rotation out of bonds and into equities. But certainly because the equities had good dividend yields, you're better parking your money in a blue chip with a dividend yield than just keep it in treasuries. And then this little kind of European bank, it's a little bit of a side note. The US banking system has been to quite an extent been recapitalized through what the Fed has done at the expense of all the retirees and people on fixed income and have savings. They've been recapitalizing the banks. That's not been the case in Europe. Europe's been unable to do that kind of directly, recapitalize the banking system. And so one of the sources of funds that the European banks have had has been their banking operations in the US and borrowing from the Fed in order to shore up their balance sheet. So this kind of flow of funds is kind of supporting what would have been a weak euro, has kind of left the euro at par because they've been funding from the Fed to support their balance sheet in Europe. So that was my initial kind of assumption about what was driving these particular changes. Now, what you can actually see, and has been well kind of telegraphed, is what the Fed and the ECB have been doing with their quantitative easing. And that supported my view that we had the QE3 from the Fed, which is basically saying we're going to inject $85 billion a month into the bond market, keep rates low, support the bond market. Now the bond market's been flat over that time period, so if the Fed's been injecting that amount on a monthly basis, over that period of time, presumably there's been quite a lot of outflows from the bond market. And the original assumption was, that was rotation out of bonds and into equities. And then you've got the ECB that have been far more aggressive in that their LTRO program, which has been funding the balance sheets of the banks in Europe, and they've been injecting the money not only into the bond markets, the periphery bond markets, but also into equities. So they've been quite aggressive in kind of supporting the equities and buying into blue chips. So the ECB program has allowed a flow on into the equities market here. I suppose the banking system in the US has made investments via what they're doing in terms of the equity markets, but it's less explicit compared to what's been happening in Europe. And then the piece of the puzzle that I think I've totally underestimated is what the Bank of Japan has been willing to do since Abe came in as Prime Minister in the end of the year. I mean, they've telegraphed it well, but the extent of it is breathtaking. And so this is, what they've been doing kind of directly. First of all, we've got an explicit target of inflation and a weak yen, and so a lot of money has flowed out of Japanese bonds into Japanese equities. It's been a tear bull market in equities, and so people have rotated out of government bonds and into equities there. They've also kind of destroyed their currency incredibly aggressively by directly intervening in particularly the European markets by buying government bonds and buying equities in Europe, and so driving up what would have been a weak euro, at least keeping the euro at parity by putting money into the European markets, the bond markets, the corporate bond markets, the government bond markets, and the equity markets, high dividend yield paying kind of blue chips here. So they've been trashing their currency and choosing the European markets to invest those funds and kind of keeping the euro at parity, and then a rotation happening out of bonds and into equities domestically. And then on top of that, again, the other side of the picture, which is kind of I've been underestimating in my mind, is the other central banks that are now kind of we know a little bit more information about directly what they've been doing. The Swiss National Bank and the Bank of Israel. Now, the Bank of Israel isn't a big kind of player in this, but what the Swiss National Bank has been a huge game changer. They've monetized their balance sheet, the Swiss National Bank, to the tune of 100% of the GDP of the Swiss economy. So the amount of money printing that's happening by the Fed in the US is about 20% of GDP, the US GDP. In Europe, the ECB has been about 30% of European GDP. The Swiss, it's 100% of GDP. So it's not a small economy. Relatively compared to their economies, a massive intervention. And so them and the Bank of Israel, probably some others, in order to drive down, the Swiss had a runaway currency because everybody was getting out of the European markets and they were kind of flight to safety with the Swiss franc. The money flowed out and the Swiss franc went ballistic, and the Swiss National Bank intervened in order to drive down their currency to parity with the euro. So they've been buying euros and buying European assets, government bonds, high dividend yield paying corporates, corporate bonds and so on, putting money into those European markets in order to support the euro and drive down the Swiss franc. Now, without those kind of interventions from the Japanese and from the Swiss, presumably the euro would be a lot weaker than it is today. The pound is still kind of going down over that time period. For me, the big question then becomes, well, if the central banks were then becoming the kind of biggest flow on here, that this wasn't necessarily a flight to safety into the US markets. Yes, there was good opportunities in the equity market in the US and good kind of dividend blue chip stocks going on there. What was really driving up the US dollar during that time period? And I suppose in my mind, the strength in the US dollar has really been the result of the Fed being less aggressive than the Japanese central bank, the European central bank, and these kind of periphery country central banks. So they've not monetized their balance sheet to the great extent that the Japanese and the Swiss and the Europeans have. So it's not as if it's a true reflection of fund flows necessarily into the US. I mean, obviously there's some of that going on, but it's strengthened because of the weakness in these currencies. So that's kind of my view on how interventionist the central banks have been and what they're doing to these particular markets. Going forward, what have we seen since the last FOMC meeting? We've got another one kind of coming up this week. Everybody's kind of on tenterhooks as to what's going to happen, what the message is. Everybody's kind of talking tapering and what's going on there. What's actually happened in the last 3 or 4 weeks, 4 to 6 weeks, has been a little bit of reversal here. So the equities market in Japan that was on a tear has kind of come off quite a bit. There, I mean, if you're up 80%, you're going to take some profits, and as soon as the market kind of comes off a little bit. It's been such an explosive move, there'll be a rush to kind of take profit. So I believe that's what's kind of driving down that move there. In terms of the currency, again, the currency has been off so much, and again, we hear stories that US hedge funds are kind of massively short the Japanese yen because it was such an obvious play. That move has gone so far so fast. Presumably, if you get any kind of little kind of flip back up, there's going to be some kind of short covering rally that's going to kind of project it as people again take profits on short trades there. So a little bit of that activity in the last 4 to 6 weeks is kind of profit taking and short covering rally, and so is not necessarily a true reflection of continuing fund flows, but just taking profits on what's actually happened to date. But then in the last 6 weeks, we've had real weakness in government bonds and the US dollar index that I showed you on those charts. And so what's actually kind of going on there? Well, thanks to Zero Hedge and the analysts that kind of support Zero Hedge by publishing material. It's a great resource. If you're not on their feed, if you're not looking at Zero Hedge every day, there's an enormous amount of good stuff that comes on there. But this is the chart this weekend for me that really kind of showed what was going on. So this is some of the Treasury analysis that comes out a couple of months late, and this is showing what was going on kind of April this year. This blue negative bar is the selling in US long-term treasuries, and a huge portion of that was Japan selling their positions in treasuries. So we know Japan over the last 20 years has built up a huge, similar story to China. China was able to depress their currency by selling, exporting to the US, and then investing that money. Instead of repatriating it back and strengthening their currency, they kept it in US treasuries, and that's what the Japanese were doing again in order to keep their currency weak. Over the years they kind of invested in treasuries, US treasuries, didn't repatriate the funds, kind of kept them in US bonds. And so they've started to actually move that money around now with this kind of outflow that we've got here. I'm not sure how much it is in terms of percentage of what they actually have, but you can see in terms of what's happened historically over the last several years, this is a big number. And so what's going on here, this is again part of the Abenomics kind of plan, is that they're selling US bonds and they're reinvesting them in Europe into government bonds in Europe, corporate bonds in Europe, and equities. And they're actually intervening in the equities market, which is a huge step to take. I mean, there's one thing to be investing in your domestic country's government bonds. That's quantitative easing, and we were all kind of 3 or 4 years ago we were all kind of shocked about that. That was like that was the nuclear option. That was pressing the button. And we have gone so much further than that. The next step now is not only buying your government bonds, it's buying other countries' government bonds. And then a step even further is not even their government bonds, but their blue chip corporate bonds and corporate equities. So it's vastly interventionist. It's just unbelievable. But they're rotating that money out, seemingly out of US government bonds, buying into the European markets in order to keep the euro strong and keep their currency weak. This short covering rally here is just a blip up. Doing this on a continuous basis would depress their currency and would keep the US dollar weak and the euro strong. To some extent, I don't think the Europeans with the ECB care about their currency being strong. If the euro gets trashed, the ECB gets nailed for weakness in the euro economy, and so the European Central Bank would prefer a weak euro in order to encourage exports out of the eurozone. But by keeping the euro relatively strong, or at least within a bound, they're not criticized for a view that the eurozone is collapsing because the euro is going down the toilet. So to some extent they kind of appreciate that kind of funds flow happening here, because it's keeping their interest rates down and supporting their bond markets, and it's also causing kind of equities flows. So the Japanese with the Abenomics here is kind of helping the Europeans, but for the time being it's kind of not helped the US dollar or the US bond market. So what does this mean? I mean, for me it becomes business as usual. I think the thing that I've totally misunderstood or misappreciated over the last 4 years is the role of central banks, and that I've always kind of underestimated what they're doing. And it's tragic. I mean, we don't have free markets anymore. This is no longer a question of looking at where are the best investment opportunities around the world and moving your money appropriate, whether it be kind of into commodity markets in South Africa, or high tech in Silicon Valley, or emerging markets in Thailand and China. No, it becomes just a question of trying to figure out what the central banks are, reading the ruins and reading the signs from what the central banks are doing, because they're willing to print money to the tune of X billions and move that money around in order to manipulate markets to think in a particular way. Going forward, though, what do we know? We know that if central banks allow rates to run away, that kind of crashes the carry trade. So rates, bond markets, if they got trashed, rates would go up a lot faster and a lot quicker than people kind of expect. All of a sudden there's less leverage in the system, and you start to crash the carry trade. So people are borrowing in Japanese yen and US dollars and investing those monies kind of either domestically and offshore. But if those rates kind of go up, a lot of that leverage is kind of stops, goes away, gets called in, and so on, and you start crashing equity markets, and then you start crashing kind of bond markets as well. And I don't think any of the central banks want to see, certainly the Fed doesn't want to see, the bond market crash in the US, because that'll put pressure on the US government in order to pay interest, higher interest charges on the US government debt. That'll kind of slow down the stimulus in the US economy, and so the Fed is in cahoots effectively with the US government, what they're doing. So no one in terms of central banks wants much higher rates. They can deal with rates within a particular range, but breaking out of that range, and I think they would start to curtail it and kind of come in and intervene in the bond market. And then from what we've seen, the Bank of Japan will clearly do anything to keep the yen weak in terms of printing yens and buying whatever assets overseas. So those are kind of the two themes kind of going forward, which would suggest that the bond market, let's go back to the bond market chart. The bond market chart, I think, is within a range. I don't think we're going to see a collapse in the bond market, because I don't think that's the Fed's best interest. And then in terms of the dollar index, we know the Japanese want to keep the Japanese yen weak and kind of continuing weak. So again, I think we've got some kind of floor. The yen is the largest component, or the yen and the euro are the largest component of the dollar index. So I think there's some kind of floor in terms of what the US dollar is worth as well, and where the dollar index will go. So there we go, a little bit of a walk through kind of international capital flows. I mean, charts are great, and I love just using the indicators, and one of the beauties of the just using indicators and charts, just need to look at that and kind of get the full picture. But in my head, I always need to understand, have a reason why a particular market is moving in a particular way. So that's what I've been kind of trying to fathom over the last 3 or 4 weeks, and that's kind of a summary of what I think is going on. So anyway, hope that's helpful to you. Let's see what the Fed does this week.